have a small
Yes.
deck as well.
Okay, so what I'll do is I will. I think people are going to roll in. We'll give them another 2 minutes.
Yeah, that's fine.
Time. Okay, so multiple parties can share the screens now. So you guys should be okay. You want to give it a try? Whoever's going to go first.
Okay, let me try. Yeah, it's definitely letting me share my screen. So whenever everyone's ready, I'll jump into it. Yeah, so my presentation is going to be about the new change, the new stress test change, and how we believe that it could potentially impact the market, what everybody here needs to know. But apart from that, I guess, while we're waiting for everybody to come in, well, what are you seeing these days now? Do you feel like there's more inventory on the market and things are starting to slow down, or pretty much the same?
It's interesting, America, because we're finding, I think it depends really on where the property is located, and it also is contingent on the type of asset, right? So I can tell you that, even a week, 2 weeks back, we were having multiple offers on most properties. And what we're finding right now is that that's not the case. A lot of properties that have multiple offers scheduled are not seeing the kinds of offers that they're expecting. In fact, multiple properties have seen 0 offers from that point of view. I don't know if it's because of the season, because there are a lot of people that are fasting now. Mindset might have changed a little bit. I think this noise about the stress testing is also causing a bit of an issue. But I think that with the weather getting warmer, it's probably just a blip for another week or two before it does, I think, get crazy again. We are seeing rates go up as well. So I'm seeing a lot of deals at the law office now that are coming in north of 3%. And so that's obviously impacting affordability. And I think that, there was a lot of people that were rushing to the market to take advantage of those locked in rates when they had those approvals. And now that you're seeing those go up by a couple basis points, it's obviously changing that, I think, in a different direction. So that's why I'm hoping that we won't see any government intervention, but it's difficult to say, right, at this point.
Yeah. That's a really good segue into what we're going to be talking about. So just let me know when you want me to start, Ricky, and then we'll jump right into it.
Yeah, I think, Omer, we can get started now. It's 6:05. Let's get going. People roll in.
Fantastic. Okay, and you're recording this session anyway.
Yes,
so if anybody wants if anybody wants the recording, they can reach out to you, Ricky. Okay, just give me a thumbs up if you can see my screen.
Yeah.
Perfect. Okay. All right. Okay, so really, this is a quick presentation. I did something similar for Keller. It was too long, so I condensed it a little bit so everybody here doesn't fall asleep. Nobody wants to fall asleep, and mortgages are somewhat of a boring topic, right? But there is something happening right now. So before anything else, let me just introduce myself. My name is Omer Amir. I am the principal of the Six Mortgage Group. We're top 1% in Canada. I've been doing mortgages for 15 years. I started my mortgage lending career at BMO. From there, went to CIBC, where I was a mortgage advisor for a little under 9 years. And then we, along with a partner, I opened up the Six Mortgage Group. We now have over 25 high-producing mortgage agents. All of them are ex-bankers from CIBC, TD, Scotia. And, this is what we do. This is our livelihood. And we help out pretty much realtors throughout the GTA. So going back to what Ricky was talking about, there's obviously something happening in the market currently, right? And there are some red flags. House prices continue to increase. We're seeing that. Another issue that we're continuing to see is the firm and multiple offer scenarios, right? This is on everybody's radar. Firm offers can be, but they're dangerous, right? Like, there are multiple risks associated with going firm. And again, multiple offer situations, you're bidding. Where do you stop? Where do you go? MLS prices are no longer indication of fair market value. So there's a lot of stuff going on. And then there's the most obvious one, leveraging that is based on extremely low rates, right? So again, the Feds pumped in a substantial amount of money, like hundreds of millions of dollars into into our real estate market, into the banking sector, to create liquidity, which offered truly low rates. But these low rates have now become a catalyst into this crazy real estate market, right? People are getting used to these 1.2, 1.3, 1.4% mortgages. And there is a certain amount of risk associated with that. So having said that, I just wanted to kind of demonstrate what that means. Then the average mortgage amount taken in 2020 was just south of $500,000. So we ran our numbers based on $500,000. And this is as of today. You can walk into any bank today and you can pretty much negotiate a 1.4% interest rate on the variable side without too much hassle, right? Anybody will give it out to you. Some banks are doing better than that. Some are doing way better than that. HSBC is doing 0.99 still. So, but what does that mean? Well, you've got a $500,000 mortgage taken at 1.4%. Your payment is about $1,700. Now, traditionally, this 1.4% rates, they will not last, right? This is due to the significant amount of money, like I said, the liquidity that the Feds have provided due to this pandemic, right? And as we wean off of this, as we move out of this pandemic, rates will eventually get to a point where they were. And even if you look at a rate of, let's say, 2.99, which is traditionally considered a very, very good rate. And as you know, fixed rates are already starting to get close to that mark anyway, right? So when this happens, what are you looking at? You're looking at an increase of about 35% in your mortgage payments or more. So right now, you have clients, I know I do, that are shopping for these 800 to 900 to 1.1, 1.2 million dollar properties, and they're doing their budgeting. And when they do their budgeting, they're calculating the mortgage payments, and they're calculating it based on these low interest rates. But what about 2 years from now or 3 years from now, right? When your payment literally increases by 40%. So that's a risk factor, right? And banks are looking at that risk factor. And banks have been in the news. You've seen the CEO of TD, BMO, RBC, literally they've been in the news and they've been talking about it. They've been talking about the runaway prices in the housing market and how something needs to be done. They're asking regulators, do something. We need some sort of intervention, right? So what does this intervention look like? Well, we got a glimpse of this intervention recently. So what is the fix, right? Like, that's the question. What's the fix? What do these people do? Well, according to OFSI, let's increase the benchmark stress test rate, and that could potentially be the answer. Okay, well, that's fair enough. What does that mean? And before anything else, who is OFSI, right? What is OFSI? Who are these people, and what's their role? So this is important to understand, that OFSI is actually not concerned about housing prices at all. That's not their mandate, right? OFSI's mandate does not concern with winners or losers in the housing market. They're all about protecting depositors' funds with the banks that they regulate, and that's all federally regulated banks. That's why they're there. So, and like I said, this isn't surprising. Every single bank has been in the news saying, hey, help us out, do something. This market needs some sort of intervention. So banks are worried about the risk in their mortgage portfolios at this point in time. And this is OFSI's answer. OFSI's come out and said, well, you know what, let's raise the stress test. So what does that mean? Well, currently the stress test sits at 4.79. So it's 2% higher than your contract rate. So whatever rate you're getting, it's either 2% more or 4.79, whatever is higher. Pretty much every time these days, it comes out to be 4.79. That's what we're using currently to qualify mortgages. Well, they're proposing that this goes up to 5.25, about half a percent in basis points is the increase. And when you see OFSI proposing something like this, you can pretty much count on this happening. This is pretty much a locked in deal at this point. Now, who does this actually impact? Well, for now, OFSI is only looking at the uninsured portfolio of the banks. So basically, these are mortgages where you have either 20% down, or you are refinancing, or you're purchasing a rental property or an investment property, or anybody who's purchasing and looking for a 30-year amortization, because these mortgages cannot be back-end insured by the CMHC or Sagen or one of the mortgage insurance companies. So it's funny because they're basically trying to restrict borrowers that are actually the most qualified group of buyers, right? These are the guys with the higher down payment, with the more equity, the higher incomes, the assets. But that's what's happening right now. And it's interesting to note that at this point in time, we're talking about uninsured mortgages, but the Minister of Finance has actually not said anything. So it's possible that the Minister of Finance comes through and says, yeah, we would like to extend this towards the high ratio insured mortgage portfolio as well, which then in turn would impact buyers that are putting down less than 20% down, 5 or 10 or 15%. So that's who it's affecting right now. People primarily refinancing, taking a 30-year amortization, or buying investment properties, cottages. So the next question is, but by how much? How much does it actually affect your qualification by? Well, it actually literally takes you away maybe 5%. That's all it does. The mortgage qualification goes down by 5%. That's how bad it is. So it's not significant. It is there, but it's not significant. If you remember, in 2018, we implemented the stress test. At that time, when the stress test came in, purchasing power was taken away. It's right off your book by 35%. There was a huge fallout from this stress test. A lot of people were affected, right? People who were selling their houses and moving on to another property. It was incredible. They were making more money than they did before, but they could qualify for less of a mortgage today than they did, 2 years ago. So something like this is not happening. And if you compare it to 2018, when when people were affected by 35%, it's literally nothing. So your purchasing power goes down by 5%. That is about it. So literally, what will this do? Well, there are people that are highly leveraged. They may not be able to qualify anymore, right? That's the biggest one. People that are highly leveraged, their qualification will get reduced. It also reduces the risks for the banks slightly. So banks have their portfolio that is uninsurable, and they'll feel a little bit better that they're doing a little bit more, I guess, due diligence, right? This will also obviously protect your depositors' funds, but mostly this will impact your young families that are in the brackets of 80,000 to 120,000 household income. They may have limited assets. They're up and comers. It's not going to affect the wealthy, right? Banks will continue to make exceptions for people that have a significant amount of net worth. We see it today. We'll continue to see that as well. So unfortunately, this could potentially exacerbate the inequality between the wealthy and people who are trying to make something of themselves. However, again, like I said, it does not make a significant difference when you look at it from a numbers point of view, right? So the more important thing is that what will this not do? Will it fix runaway housing prices? No, it's not. It's not going to help runaway housing prices. Will it slow down multiple offer conditions, what we talked about earlier? Will it slow down all these firm offers that people are putting on to properties and so on? No, that's not going to happen as well. Will this create a smokescreen for politicians and bureaucrats so they can look like they're doing something? Well, perhaps, right? Like that may be something that it will do. Along with that, obviously, when you put something out there, when something is in the media, when people talk about it, it garners attention. and you have people talking about it for a few months maybe, right? So you might see a little bit of an impact initially, but ultimately we feel that the market will come exactly back where it is right now, and I think that there will be a very, very minimal impact. So I guess, the next question that we come up with is, then why just this? Why has the government not done more, right? Why have they not been able to do anything else in order to stop these multiple offer situations, these runaway housing prices, and so on? Well, I mean, the reality is that it doesn't look like they have anything else that they can do, right? And that's the truth of the situation. There's been a lot of things that the feds have done and the government has done, that hasn't actually worked, right? So the pandemic has literally stripped away the illusion that our housing market has been driven by foreign investment. It's right, like, since the pandemic happened, how much foreign investment is coming into Canada, and how many foreign investors are buying properties? Not that many. Certainly, we're not seeing any. I don't know if you are, right? And look at what the feds did, right? These are all distractions, right? They put a foreign buyer speculation tax, vacant home tax, all of that. What has that done? Has that slowed down prices at all? No, nothing. It's done absolutely nothing in the market. There's only one thing that actually helps, and that could actually potentially help, and that's an increase in supply. That's the reality, right? The more of something that actually exists, the cheaper it gets, plain and simple. And you can't slow down demand in Canada. It's just not possible, right? Just as Canadians continue to have children, we also continue to welcome much needed, economically vital immigration. And as that happens, we need more supply. But there's been, the feds have not been able to do anything about that. And even with as much money as they can put in today, they will not be able to solve the supply challenge, at least in the next 10 years. So what does that mean? Well, literally, that really means that prices will continue to go up. Demand is there. You can't curb it. Supply is not. So prices will continue to do what they have been doing in the last 50 years, right? This is a historical chart, literally taken from TREB all the way back to 1975. Prices have doubled every 10 years. Now, obviously, there's some ups and downs. Prices go up sharply, come down a little bit, but overall, it does the exact same thing as it always has done. So this one particular change, we don't feel it's going to do much. Now, having said that, there are a few words of caution, and this is mostly for our realtors here, that you guys need to kind of pay attention to. The first one is pre-approved clients. If you have pre-approved clients that have been pre-approved and they know that they qualify for, let's say, $800,000 or $1 million, well, with the stress test coming in, make sure that they are pre-approved again, or their numbers are vetted again, because when the stress test does change, come June 1st, their qualification amount could potentially go down. The second one, which I'm a little bit more worried about, is pre-construction clients, right? Because one thing we know is that the government has absolutely zero respect for contracts, right? And we saw that when the foreign buyers tax came in, right? People had bought properties 3 or 4 years prior to the foreign buyer tax coming in. Guess what? They still got slapped with a foreign buyer tax. So make sure, if you have pre-construction clients, they find out from their financial institution, their banks, if their deal will indeed be impacted by this particular stress test that's coming in. Hopefully, banks will have redundancies and clauses that will grandfather these mortgages, so there isn't a challenge in qualification. Otherwise, the clients may need to come up with more of a down payment. But apart from that, this change in stress test, it's certainly not going to make a significant impact, and regulators know that, right? And this is why regulators have not been meddling with the market as much. I mean, you're obviously going to have a lot of people that are the opposition side, that the critics, right? That they will talk about these low interest rates, and then they'll continue to compare the scenarios with what happened in the U.S. We're not in that same market, right? We've never been in that same market, right? There were significant challenges in the U.S. prior to 2008. And bunch of it stemmed from obviously the teaser rates that they used to offer, and a lot of these people try to equivalate these teaser rates with the low interest rates that we're offering today, but that's not how it worked in the US. There were balloon payments attached to these teaser rates, and the whole strategy was that at the end of this teaser rate, the clients would get to refinance and continue to take on another teaser rate, right? But when there's no more equity left in your property, guess what? You can't refinance. Those teaser rates disappear, right? And our underwriting and our mortgage qualification, along with the stress test, has these redundancies built in, right? So when you are stress testing your client today at 4.79, yet you're giving them a rate of 1.4, well, you're stress testing them 3% higher, or 3 times higher than what they're actually taking on today, right? So in reality, our lending is still very prudent. But again, the challenge is not prudent lending, it's more about shock, right? And there will be a lot of clients that will see the payment shock when their payments go up by $1,200-$1,300 at the in the next 3 years or 2 years or whatever it is. And to protect us against that, OFC has come up with this solution, this plan. Again, will this help? Maybe, potentially. It could potentially help the banks reduce their risks. Will this help our market? Will it help our prices? Any of that? No, it's not going to have an impact, none whatsoever. If you can buy real estate today, get in, buy it as soon as possible. Nothing has changed. Prices will continue to go up. They'll continue to rocket, because the challenge here is not of anything but supply, and demand will always be there. That is it for me. I'll move it over to Chrissy, and then I guess we can do questions if anybody has them later. Yeah, there you go.
Perfect. Thank you so much, Omer. The only thing that I will potentially add is right now, with talking about this stress test and it being conventional, the one question that a lot of people are worried about bringing to the government is having one stress test for high ratio and one stress test for low ratio. The waters are going to get very muddy. So even though the talk right now is this just being conventional, that doesn't necessarily mean that it's going to stay that way. So again, stay tuned. I'm just going to share my screen. Perfect. So again, thank you so much for having me on today. I'm Chrissy Walker. I am from Sagen, and you guys probably know us as Genworth in the past. We changed our name at the end of last year due to an ownership change. So our majority shareholder was Genworth in the States. It's now, we're no longer affiliated with them. So we've been able to come up with our own branding, and we're now bought by Brookfield. So again, we're super excited to have Canadian ownership. With the changes that CMHC brought in last year, as far as them reducing their TDS and GDS and increasing their credit score, for anybody that hasn't heard so far, we didn't make those changes. So with us, our underwriting still stayed with the government maximums for TDS and GDS, and we still stayed with the minimum credit score. So again, still make sure you guys are sending those files over to Omer and his team to get those pre-approvals, but just know there's still options out there and not the whole industry constricted. With the changes, again, we became not only the largest private residential insurer, but we actually became Canada's largest default insurer. So we're excited to take that title over from CMHC. With that, I'm going to flip over. So as far as us, we do support all of our real estate partners. So if you do ever have a reason to reach out to Sagen, we do have local account managers that you can either reach out directly to our 1-800 number, or again, if you have specific questions for underwriting, make sure you're going to Omer or his team. But we do have regional, okay? So today you're seeing me. Next time you're actually probably going to see Sherry if we're invited back, because she's more local to you guys. I did throw this slide in here. If you do ever have customers that are facing financial challenges and you know that they were high ratio insured through Sagen, just know the option for some sort of assistance is out there. One thing I'll put in is in my region, one of the things we've seen recently is the house was going up for sale. It was a hoarding situation. What happens is we actually stepped in and cleaned up the property prior to sale. So again, if you ever have someone that is Sagen insured, some sort of financial distress, make sure you're making a referral. We do have a portal now that you can actually refer them directly to, and then we circle back with the institutions in which they're insured with to let them know what kind of assistance we're willing to offer and see if they're on side. We did have 750,000 families in Canada take some sort of mortgage deferral. And again, there was a lot of speculation as far as the deferral cliff and what happens when those deferral ends, but realistically, there was no deferral cliff because the government was swift with their action as far as stepping up with assistance. And a lot of those 750,000 families only took the deferrals as a precautionary measure. So we don't really expect going forward to see a whole lot of house price decrease because of the pandemic. Again, it's done exactly the opposite and prices have flared. I thought today I'd throw in a couple hot topics just to let you know that we do have the availability for you guys in case you didn't know that they were out there in the market. We do have the family plan program. So again, as Omer mentioned, if it's a rental, it has to have 20% down, but we do allow owner-occupied properties that are to immediate family members. So if you have a parent that's buying for a child, they could do it with 5% down. If you have somebody that's buying for their elderly parents to move into, again, that can be done with 5% down. We will allow up to 4 insured mortgage programs. Another hot topic that's happened is with the pandemic, we've seen a surge as far as vacation homes go. We do have vacation and we do have secondary homes. So just as a reminder, if it's a regular home in a regular setting and they're just classifying it as their vacation home, it can be purchased with 5% down. If it's missing one of the elements of a regular home, so say it's not, it doesn't have year-round access or not fully winterized, doesn't have potable water, doesn't have a permanent heat source, those would then put it into our vacation home program with 10% down. But again, if you have clients that are interested and say they don't have enough saved, they don't necessarily need that 20% down. I did want to quickly mention our business for self stated income program. And again, please, 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 if you do have business for self, make sure you are referring them over to Omer for that pre-qualification. We do recognize there's going to be a lot of business for self people that have been affected by the pandemic. With the pandemic, again, they've had to close their stores. Their 2020 income might not be what it necessarily was in 2019. So if you have customers that come to you, and again, I know you guys take mortgage courses and you're in the know, just recognize that things have changed. The insurers have realized that there is a need to kind of step up. And our business for self, where we're using the stated income program, is going to be ultra popular. So again, Omer and his team, they recognize what the program parameters are and they know how to qualify your clients. So please, please, if somebody comes to you and says their income has been affected, don't necessarily rule them out. Purchase Plus Improvements program. Again, I personally love this one. If you are listing a property that say is a little bit distressed, maybe they don't have the money to repaint or there's carpet in it and they don't want to pull out the carpets and do hardwood, just know there's the option for them to roll it into their mortgage. So the one thing you could potentially do is if there's carpets, you could get a quote for hardwood. And then as people are coming through the property, you could say, hey, I know carpets aren't a great feature. Here's a quote. You can roll it into your mortgage as part of the Purchase Plus Improvements program. Again, I added just a list as far as some hot things that are generally used. So again, flooring upgrades, if you are selling a new construction home and they want to finish the basement, that would be an option. Kitchens, bathrooms, again, those are all things that we see most often through this program. We do have on our new website, www.sagen.ca, we do have a learning center. On there, we do have weekly webinars, and we do have a home ownership week coming up. And I have a slide just at the end that'll kind of touch on some of the topics. But again, not all of our presentations are based on products. Sometimes it's how to present virtually in this virtual market. It could be social media tips. So again, check out our website, see if there's anything of interest to you guys. The other thing we do have on our website, it's either linked to our website or it's www.marketingsource.ca. There is a realtor version to that website that you can sign up, and there's actually customizable material that say is top 10 closing costs for home buyers, that you can put your image on there, you can put your information on there. We know that any marketing material you guys have costs some sort of money for you. So there is customizable content, and it's kind of pre-sale, there's after sale, there's different categories to it. And again, all that's free. Another thing is, if you're looking at either working on your social media game or starting out in social media, make sure you follow us on the socials. With us, we do post usually anywhere between 3 to 5 times a week. And again, it's different content. Sometimes it is product specific, other times it's not. So again, you can always like, share, comment, add your own suggestions if you're again trying to figure out how to add more content to your day. The other thing we have for you guys is under our tools and resources on our website, we do have a home ownership digest that's put out twice a year that has articles in it that you could share on your socials. We do different studies. We usually have one different study every year. So this year, actually in May, we're releasing our first time home buyer study. You could either share the PDF or you could even pull stats out of it to share on your socials. Again, just have more content for you. And Homeownership Education Week, as I mentioned, is May 10th to 14th. So do register for some of our free webinars. There is going to be an Equifax webinar. There is going to be a realtor roundtable webinar. There's going to be a market outlook, and there's also going to be I'm missing one. I forgot what it is. Anyways, again, make sure you check it out. They just got posted today, and register for them. You never know what kind of information you're going to be able to find, as well as share it to your socials. So with that, I will open up just to kind of see if anybody has any questions.
Hey,
Guys,
what's
go ahead
that
and
site
unmute
called
yourself.
again?
Nav, did you say something? Can you repeat your
Yeah,
question?
can you hear me?
Yeah, go ahead.
Okay. Yeah, what was that site called again? The marketing source? What
So
was it?
I'll put it in the chat, but it's www.marketingsource.ca.
Okay. All right, thank you.
Perfect. Well, thank you so much for inviting me. Again, if you have any questions, either reach out to myself, Sagen, or Omer and his team, and any of us would be happy to answer your questions.
Does anybody else have any
Thank you so
questions
much.
for Chrissy or Amir here? Okay, Amir, I actually have a couple questions if that's okay.
Absolutely. I was hoping you would.
So, I mean, I think you hit the nail right on the head. It is a supply issue. And a lot of the agents on this call were a part of the 14th roundtable, Rotman roundtable that was sponsored by RE/MAX. And they talked about the supply issue and potentially looking at the green belt for solutions and some of the issues involved with that. So you're right, it's definitely a supply issue. And second to that, for some of the other people on the call, I think the supply issue is only going to get worse because we're going to have an influx of demand once the borders properly open up. And I think there is a lot of pent-up immigration. So for those of you that are thinking that this is it, there's going to be some sort of a burst or a crash, I wouldn't bet on it. But again, we'll have to see what happens. Omer, on that front, so a lot of the people that are buying right now, especially in the last 3 to 4 months, they've grossly overpaid as far as the market is concerned, right? I mean, from a demand perspective, they paid what the market was willing to bear when they made the offer. Are you finding that appraised values are coming out lower right now? Are you seeing that happen at your office?
So, this actually brings us to one more point that I kind of wanted to talk about and hit a little bit in more details is really the challenges with firm offers, right? And there are significant risks with going in firm on properties that we all need to understand and communicate to our clients, right? And again, exactly what you just said. Risk of equity, that's one of the biggest ones. You purchased a property for 1.2 million, 400,000 over asking or 300,000 over asking. Now, what if it doesn't appraise? So right now, as of now, we actually have not had any appraisals come under value, and it's quite interesting because I think 4 months ago, no, yeah, around December time or January time, yes, somewhere around there. We had, like, I live in Durham in Whitby, right? And someone bought a townhouse for $940,000. And literally before even seeing the deal, my first indication was that this is not going to appraise. It's not going to, it won't happen. We're in trouble. And it didn't appraise at that time. Good thing is that they took a June closing. We ordered a second appraisal last month. It came in because these sales continue to become comparables and benchmarks for each other, essentially, right? So that's what's happening. That every sale that happens is now, a comparable for a property in that same neighborhood. But it is still, it's still a risky proposition, especially if your client is going in firm and they don't have a plan B. They don't have some sort of backing, either from the bank of mom and dad or some sort of backup plan, right? Risk of equity is one of them. Another thing that I see a lot of is that people, hold up their pre-approval and they believe that this pre-approval gives them the right to go in and bid on anything firm. Well, that's not true, right? A pre-approval in all reality is just a rate hold from the bank. Most of the time, these pre-approvals are not even adjudicated. They're not underwritten. And Chrissy will tell you that insurers don't even look at pre-approvals. So if you're putting less than 20% down, your pre-approval has never even seen the day of light with CMHC, Genworth, Sagen, or Canada Guarantee. It's never been there. And another problem with these pre-approvals are that most of the time banks are extremely busy. So most of the times these pre-approvals are system generated. And if they're not system generated, documentation is not being reviewed up front. So nobody's looking at pay stubs, employment letters, T1s, T4s, none of that, right? Especially down payment. Nobody's reviewing down payment for pre-approvals because no one has the time. When the system is already filled with live applications and live deals, no one has time to sit there and adjudicate pre-approvals. No bank does anyway, right? Your broker might, like if you give it to me, I'll review it, but your bank is not going to be able to review it from an adjudicator's level. So that puts us in a significant amount of risk because, you go ahead, you buy something and you take it to the bank and you say, here's my pre-approval. And then the bank looks at your deal and they come back and they say, wait a minute, you said you make $80,000, but it's not you. Your company makes $80,000 because you contract out under your corporation. So now we need your notice of assessments and T1 generals. And it could be anything, right? It could be something as rudimentary as that, or it could be something like, the subject property that we've actually had that. A client was fully pre-approved by TD, went and bought a property, wrote a subject-free offer, credit was clean, everything was great, brought the deal back to TD. TD looked at it and said, wait a minute, we don't do, what are they called? Those hobby farms, sorry. I had a brain freeze over there. TD said, we don't do hobby farms. This is not a deal that we're going to do. Client just, that's it. Like there's no, once they say no, that you can't do anything. Thankfully they were able to find financing with an alternate financial institution that indeed did hobby farms. But that's the kind of risk that you're putting yourself into. right? So there's obviously the risk of the subject property. Status certificate, that's another risk. Ricky, you and I, we've actually talked about status certificates, right? And you're going in firm, and then the bank finds out that um, your condo fee has gone from $400 to $600. Well, why is that? That could be a major issue, right? And they could deny financing just based on that. Obviously, insurers, and Chrissy, you know about this, insurers have properties that they've blacklisted. There's a lot of those properties that are completely blacklisted for various reasons. I mean, sometimes they're stigmatized properties. Sometimes it's just something like, the reserve fund on a particular condominium building wasn't adequate enough. And the last one, which is just insane, and we've seen it happen, where a client was pre-approved by a bank, everything was good, credit was good, whatever. They came to us because they needed financing. The bank had ultimately said no, and we found out. We asked the clients, what happened? Why did the deal fall through at your bank? Well, it's because their entire down payment came from a country that's sanctioned. So at the time of the pre-approval, the banker sat with them and asked them, how much down payment do you have? And the client said, I have 20%. Well, fantastic. With 20%, you get approved for 800,000. What they didn't ask was, where's that 20% today, right? Unfortunately, it was in a bank account that is at a sanctioned country. So there's significant amount of hurdles that your clients could potentially go into with these firm offers, but what are you going to do? Like everything is going in multiples and firm offers. So how do you protect yourself and your clients against these firm offer situations? There's no right answer, right? And we've been talking to industry experts about could the regulators come in and just regulate something like you have on pre-construction properties. You have that 10-day cooling period. Could you implement that on every single contract? And if that would help. But again, that's not an answer as well, because that would create its own issues, right? And what do you think, Ricky?
So see, from the law office's perspective and the broker's perspective, is two different perspectives that relate to the same sort of thing, right? And what I'm seeing at, for example, the legal side of things is that people have become, to some extent, ruthless, right? I actually saw a file where the funding was literally 10 minutes late. And because of that 10-minute delay, the sellers refused to complete the transaction because it was 10 minutes after 6. The next day, the property was relisted and sold for $150,000 more than the property was originally acquired for in February. And so our conversation, as far as the clients are concerned from a legal perspective, is that make sure you're prepared. And even with a lot of our legal files, we have rush fees that we've added in, because if your mortgage drops at the 11th hour on the day of closing, we've got to drop everything to prioritize your deal so you don't end up in a situation like that. And people think it's a get rich quick scheme, but it's twofold. It's one, we want to put pressure on the person providing the funding, the bank or the mortgage agent involved, to get that filed to us as quickly as possible. And two, because it does take a lot of resources for a law office, even my size law office, to turn files around and get them funded on time. And so I guess my advice to everybody on this call, whether you're an agent or not, and you're in the market, is that you've got to make sure you've really done your due diligence and your files are intact and you're ready to go. Because if you're a minute late and your contract says time is of the essence, you're in a shit show, especially if the other side doesn't want to accommodate you. And I can tell you now, because of the way the prices have exponentially increased in the last couple of months, a lot of sellers are saying, screw it, I'm just going to pocket 150K cash and move on. People have become very, very, very crazy now because money's going to talk at the end of the day. The second thing from the broker side is that for those of you that are writing many offers, a lot of you are going to the bank and getting your deposit checks up front because you want to look prepared. And a good broker will do that. But if you've had to do that 4 or 5 times and the lender sees 4 or 5 payments come in, out, and now they're reviewing your bank history and they're trying to figure out why is the money coming in and out. If you haven't kept your paperwork intact and you don't have answers to those questions, you as a broker are going to screw your client, because the bank will want answers as to why the money came in and went out and came in and went out over and over and over again. So it all goes back to being prepared, right? And there's no excuse, I think, today to have everything last minute, especially when you're dealing with the kind of purchase prices that we're dealing with right now, right? It's a very, very, very nervous time for a lot of people. And especially with builders, I find the builder community, they're looking for any reason the buyer, if they fall through the cracks at the 11th hour, the builder knows they're going to make a lot of money on that transaction. Those lawyers are usually ruthless. And so again, it just goes back to being prepared. You want to be as prepared as you can in this marketplace.
Yeah, I was literally about to add that we're seeing that with builders a lot, where builders are not willing to give any sort of extension. They're coming back in the 11th hour. Your closing is in 14 days or 20 days. Yeah. And sometimes literally your client is not prepared. So make sure your clients have an approval in hand. Most banks will offer pre-construction financing, where they'll hold, they'll do a rate cap at least, but more importantly than that, at least an approval will be held, right? Because banks' volumes right now are through the roofs. If you are submitting an application to, let's say, TD, CIBC, you're not getting an answer within 7 to 8 business days. That's how busy they are. There have to be significant amount of escalations in order to get an approval within 48 hours. But that's just where we are right now. If you don't have a condition on financing on a file, then yeah, like you're waiting. So
yeah, and even those conditional periods aren't good enough, because if it's 7 or 8 business days to get the file reviewed, your standard 5-day condition is not going to fly. It's not happening.
And I think when you have when you have a firm offer, then there's no urgency from the bank at that point. You've already bought firm. So, it's like, yeah.
And you know what? It's funny that you say that, Omer, because as a lawyer, if a deal comes to me firm without a lawyer's approval, and I see that there's a problem with the contract, well, the contract's done. I can't rewrite it at this point, right? So I think lenders love it when that happens too, because it's not their liability. It's not their risk. They didn't take it on. Right.
Absolutely.
So my last question, I guess, at this point, Omer, is that a lot of people are worried about interest rates going up quickly. Do you think we'll see 6 or 7% interest rates anytime soon? Any predictions on what we might expect?
No. Yeah. So interest rates will not be going up fast anytime soon. Bank of Canada has obviously gone on record and said that they don't expect interest rates to go up for at least 2 years or 3 years. Even when they do start going up, you're going to see slight adjustments in interest rates. Nothing more. And the reason behind that, again, is that you've seen the government put in somewhere close to $400 million into our market. All that money is not going to go to waste if they just start jacking up the interest rates. It just the amount of liquidity that they provided our market. It's something that will not happen. This is going to be a slow recovery. And at least for the next 3 years, you're still going to be in a very low interest rate environment. So that I can put you at ease is not going to happen.
All right. Anybody have any final thoughts or questions before we sign out? Go ahead, Ben.
Yes. Amir, I have a question. I was in a similar situation. One of my client is from out of country. He said he will have a 20% of deposit. So I wonder, is there any website or list where you can tell those sanctioned countries you said where the money is coming from? Like they're not allowed to?
Yeah, you can. You can actually just Google sanctioned countries, Canada, and it'll take you to the government website, which will list all the sanctioned countries. Okay. Or you can send me an email, and I'll send you the list myself as well. Just because the money is coming from a sanctioned country doesn't mean the money's dirty, right? So yes, there are banks that will give you a hard time about where the money is coming from, and if it's coming from a sanctioned country, it doesn't necessarily mean that they will not be able to make this purchase just because that money is coming from a sanctioned country. No, there are still ways of ensuring that the money's going through FinTrack, and there are particular lenders that will still continue to look at those transactions. So it's not like your client is out of luck.
No, because my last client, they were actually originally from Syria, but they were living in UAE. So I sold them the property, and actually they brought the money from UAE. There was not a problem. So I just want to make
UAE is
sure.
not sanctioned.
Yeah.
Yeah, UAE is not sanctioned, so no challenges over there. But yeah, no, you're absolutely right. It is something that you want to do your due diligence on prior to, right? Because
Yes.
another thing we obviously know, when money comes in from these places, it's not small amount of money either, right? It's generally large amount of money.
Yes.
So you want to make sure that you do your due diligence. Absolutely. I mean, please do connect with me after the call, and we can discuss that particular scenario for you as well.
Thank you.
Fantastic. Okay, thank you everybody for attending. Omer, always a pleasure. Thank you, Chrissy. It was very good to have you on the call as well. And I'm really looking forward to having you guys come and do this again. It's a lot of insight, and I think as a collective, we all really benefit from having these conversations. So thank you again.
Thank you.
Okay,
Thanks again,
everybody.
Ricky. Thanks for having us.
Okay,
Thanks,
bye,
everyone.
guys.
Thank you, everyone.
Thank you.
Thanks, Chrissy. Take care.